Welcome to a introduction of chapter 15. And this chapter is the introduction to managerial accounting. All right, so we're going to just go over the first two objectives. This chapter has four different objectives, but we're going to focus on the first two. The first objective is to describe how managerial accounting supports the management process. So we're going to actually look at what the management process is and how managerial accounting actually supports that process, and look at the differences between managerial accounting and financial accounting, and also look at managerial accounting's place within the organization. That's what we're going to work through in objective one. All right, let's get into it. All right, so first and foremost, this chapter is an introduction of managerial accounting. But before we even go into an introduction of it, we need to at least know what managerial accounting is. Managerial accounting, sometimes called management accounting, because it deals with all of the dealings inside of an actual organization. So, managerial accounting is the accounting that deals with the process of developing information and management tools to achieve the organization's objectives. So, we talked about previously what accounting was, and accounting is the language of business, right? And by being the language of business, you have financial accounting and you also have managerial accounting. And we all remember that financial accounting was all about the numbers and all about the data. And managerial accounting is actually what we do with that data. Okay. So, managerial accounting is the management accounting on analyzing and what to do with the data for a business or organization to reach its objective. Okay. And so within managerial accounting, you have a management process. This management process has four different phases or functions. Okay. And we say phases, however, um, they don't always have to go and start in order or any time frame. It's just the different areas within the management process. Okay. Those four functions or phases are strategic planning, measurement, evaluation, and control. Strategic planning is the top of this management process. And strategic planning is where your management process begins. This is where your long term objectives and goals are set up and established. And long term really has a time frame about 5 to 10 years. And the strategic planning is done by your high execs. So think your CEOs, your CFOs, your top management, top executives of a business or organization. That's who make these decisions, your strategic planning decisions. Okay. That is all your long-term goals and objectives. But within your strategic planning, you have operational planning, and that is where your short-term goals are developed, and so that you can know your day-to-day functions to operate the business. So they set those goals and actions for the business, and that's operational planning. And then strategic planning is for your long-term objectives. And then you have the measurement function or phase. This is the process where managers develop and agree upon performance metrics on how well the company is achieving the objectives that were set in the planning phase, either the strategic or operational planning phase. Okay. So in measurement, you have your top level managers, they are going to actually figure out how they will measure those objectives. So the objectives are set, and then there's another set of managers that will determine how to measure it. And then evaluation is actually the process where management monitors the operations So they monitor the measurements. Okay. And also that's where the work is actually being done. So the work is being done and management will actually go and evaluate the work that's being done. And then when they evaluate, they're actually doing comparisons. They're comparing the actual versus the expected results. And then you have control. Control is also considered your audit phase. And this process is where management takes action to encourage specific behaviors or outcomes. Okay, so you have control where in evaluation you see the actual results, and if they go above the expected results, then what can you control to keep that going better? Or if it's going below your expected results, then what can you do so that you can do better, or so that you can get at least up to the expected results. So your control is where you actually make adjustments. Okay. So you have the planning, the strategic and operation planning, where the objectives are set, the measurement, where the performance metrics are determined, evaluation is where you measure, and control is where you make tweaks. Okay. Now, when you are in the measurement stage, you have to be able to have, there are a lot of different considerations and choices that come into play when you're developing your cost information, because the cost information is the information that you're going to be actually making the decisions on. And you have to be able to have to know what to consider when you're making those decisions. So some examples will be what cost system to use to record and report the cost of a product. That's a way to measure something. How to allocate overhead costs. So overhead costs would be like equipment depreciation, right? So then the measurement will be, how would we decide to break down those costs for depreciation? Okay. How to allocate your support department cost, how to allocate joint manufacturing costs, how to report fixed production costs, how to determine and report variances, which a variance is just a difference. Okay. So in the measurement section of this management process, when it says you develop and agree upon the performance metrics, you have to take the information and consider the choices so that you can make the decision. And also, when you're deciding upon what metrics to use, you have different tools to use. So the different tools that you can use are cost volume profit analysis, budgeting, decentralization, differential analysis, and capital investment analysis. For the time being, you don't really need to know these. You just need to know that they exist, because later on in the class, each of these different tools will have its own specific chapter. But you just need to know that tools do exist for them to be able to make the decision. So going back up to the measurement phase says where the managers develop and agree upon performance metrics. They do that by developing costing information, taking things into consideration, um, so that you can develop your cost information, meaning how are you going to get the information you're going to measure, okay? And then deciding what tools are you going to use to make decisions based off of that information. These are the things that are done in that measurement phase. Okay. That measurement phase is one of the most important phases of the management process. All the processes are important. However, depending on how well the measurement phase is constructed will determine how good the other phases are to the organization. Okay. All right. So we're going to move on so that's the management process. Okay. But that's all good. But why are we doing this? When are we doing this? Right. So that question is answered when you know the difference between financial accounting and managerial accounting. Okay. So financial accounting is what you learned in your principles of financial accounting class. That is when you take the information and data from a company's transactions and you classify it into assets, liabilities, equity. When you classify those transactions, you record that into financial statements in financial accounting. Okay. But in managerial accounting, you get the information from these financial statements, the information that's included in these financial statements, they help to create your managerial reports. Okay. And the biggest difference between managerial and financial accounting comes in three questions. Okay. It is what is included, which we're going to go into more detail, and how it is reported. Okay. So in financial accounting, what is included is financial statements. In managerial accounting, it is managerial accounting reports. Okay. Who uses these information? Who uses the different information? Because that is a big indicator difference in managerial and financial accounting. So if I'm taking notes on the difference between financial accounting and managerial accounting, I would write on my paper financial accounting and draw a line under it so you can write out a list. And then over to the side of it, I'll write managerial accounting, draw a line so you can make a list. Okay. And then I would make it look similar to this chart here. So financial accounting has financial statements. Managerial accounting has managerial accounting reports. Who uses the financial statement? Financial statements are used for external users, investors, and company management. Managerial reports are for internal users and management. Big key difference. Okay. The nature of the information. The financial statements from financial accounting, your financial statements in financial accounting is objective, meaning whatever information you input in will determine the information that's outputted out. Okay. It's objective. It is what it is. Managerial accounting is objective and subjective, meaning whatever information you put in will be what you put out, but subjective because you can ask for what you are looking for. Okay. So what does that mean? So objective managerial account would be what are the time records for everybody that worked on the assembly line. Okay. That is objective because whatever information that was put in on when they clocked in and clocked out, that's going to be the information that's reported out. That makes it objective. But it's subjective because you decided what you actually wanted and kind of fine-tuned that request. Okay. Financial statements are prepared according to GAAP. So you can just put GAAP, and that is GAAP is generally accepted accounting principles. Okay. And this is a standard. GAAP has rules and regulations so that all companies that report financial statements that are in accordance to GAAP, they're all uniform. Okay. Managerial accounting reports are prepared according to management needs, meaning that there is no regulation. Coca-Cola and Pepsi have the same type of product, but their management reports can all look different. Okay. The timeliness of the reports. because a financial statement is required or is according to GAAP, GAAP requires that financial statements be prepared at a fixed interval. That could be monthly, quarterly, annually. Okay. And your managerial accounting reports, they can be prepared at a fixed interval. However, it is on an as needed basis. So if management says that they want it monthly, quarterly, or annually, then that's when it's due. But every company is not uniform or universal to every company. So it's basically as, or it can just be as needed. You may pull the payroll report once a year whenever maybe when management is looking at that information for one particular reason, right? And then the focus of the report. Financial statements focus on information on the company as a whole. So it'll take the total income that the whole company received, right? And managerial reports may report on the company as a whole or as a segment. So if we have Nissan, for example, Nissan may want a managerial report only on the Nissan Titan truck or the Pathfinder or just the Altima or just the Maximum, right? Not the whole company as a whole. So those are the differences between managerial and accounting. The difference is the type of reports, who uses those reports, what kind of information is in it, how is it regulated or prepared, the time intervals when it is prepared, and the focus of those reports. Okay. These key things are very important on the differences between financial and managerial accounting. So if we looked at the difference of managerial accounting reports, now we see how the management process plays into this, because the management process has those four phases: the strategic planning, the measurement, the evaluation, and the control. And those four phases help to produce these reports. Okay. So while we're still on the subject of management accounting within your organization can be, so those managerial accounting reports that we talked about in the chart, they can be segmented out through verticals or horizontals. Okay. So a vertical in a company, vertical goes up and down, horizontal goes side to side. So think about verticals only affect one thing, like a row, right? So, like on a spreadsheet, you have a row that goes up and down. That only focuses on that one focus. But that's a column. I'm sorry. A column goes up and down. It's vertical, and it only focuses on that one focal point. However, a row goes side to side. A row can encompass many columns, right? So how does that look in business? A vertical would be considered maybe like a business unit. And sometimes they can be separate, can be structured as a separate business within a parent company. So vertical products are example could be verticals could be products that are sold directly to your customers and products sold directly to other businesses. Okay. And horizontals are departments within the overall company that can be a support to each of the verticals. Okay. So let's take a look at an example. All right, so we have an example company called McAfee. All right, McAfee is actually a real company, but we look at McAfee, okay? So McAfee has the CEO, which is your chief executive officer, right? That is the person that is in charge of all of your staff. That's the leader. Okay. And then under the CEO, you have your executive vice presidents. So your executive vice presidents or your senior vice presidents are who directly report to the CEO. Okay. So all you got in this example, we have 7 people that report to CEO. You have your executive vice president of consumer business unit, your executive vice president of an enterprise business unit. These are 2 verticals. Okay. This is a business unit that sells directly to consumers and an enterprise which could sell directly to other businesses, right? So these are your 2 business units. So your horizontals would be sales and marketing, finance, technology, your management or general counsel is like your lawyers, human resources. These are your main horizontals because they support both of these units, but the executives of each of these report directly to the CEO. Okay. But then you can go even deeper into support verticals and support horizontals, where although these vice presidents don't support these executives per se, the CFO right here, your chief financial officer, who reports to the CFO is your VP of finance for consumer here, your VP of finance for enterprise, your VP of finance for sales and marketing, your VP of finance for consolidations, which will be, which will be for all of these. And then your VP of accounting. Okay? And this is a direct example of horizontals and verticals in a business. Okay? So remember, verticals are business segments or business entities, and they go up and down, and horizontals go sideways, and they support the different units. Okay. So to recap, we have the differences between managerial and financial accounting. We have the 4 phases of the management process, which is strategic planning, measurement, evaluation, and control. And then we have the management accounting within the organization, which we have our verticals and our horizontals.